Have you ever wondered about the potential of multifamily housing in the current real estate landscape? With a staggering $1 billion in investor commitments, ACRE is making a bold move in the multifamily housing sector. Welcome to the Multifamily Real Estate Insights Podcast. I'm your host, Sandy MacKay. Let's get right to it. In a significant development, ACRE has successfully raised $1 billion for its second credit fund, signaling a strategic bet on the multifamily housing sector. This fund, known as the ACRE Credit Fund 2, reached its hard cap with commitments from a diverse range of global investors. These investors include pensions, insurance companies, endowments, asset managers, and family offices, all eager to tap into the opportunities presented by alternative lending in the residential real estate market. Daniel Jacobs, managing partner at ACRE, emphasized the timeliness of this move, describing the current environment as one of the most compelling backdrops for multifamily credit in over a decade. Jacobs pointed to several factors fueling this opportunity: a persistent supply and demand imbalance in housing, the looming surge of loan maturities within a high-interest environment, and evolving bank lending practices. ACRE's strategy is not unique, as other major players like Kayne Anderson, Barings, and Pretium are also exploring multifamily credit opportunities. The broader dislocation in commercial real estate has attracted industry giants such as KKR and Blackstone, showcasing the vast potential for investment in this sector. ACRE distinguishes itself through a vertically integrated approach, offering a combination of lending, equity, and development strategies. With offices in New York, Miami, and Atlanta, ACRE is targeting high-growth markets in the United States. The firm's deep borrower relationships and disciplined underwriting strategy are key components of its approach. Founded in 2011, ACRE has an impressive track record, having conducted $7 billion in real estate transactions across 195 investments. The new fund increases ACRE's lending capacity to $4 billion, further solidifying its position in the market. Additionally, ACRE has completed 4 public securitizations, structuring $3 billion in deals that include commercial real estate collateralized loan obligations. CMHC improvement. Mortgage loan insurance is offering a great opportunity for home buyers looking to purchase an existing home that needs some work, or for those building a new home from scratch. This product provides insured financing up to 95% of the as-improved value for 1 or 2 unit owner-occupied properties, and up to 90% for 3 or 4 unit properties. This allows clients to finance their residential property purchases or home improvements with lower down payments, making it more accessible for many Canadians. One of the standout features of CMHC improvement is its flexible financing options for both small and large-scale improvements and new construction. Insured financing is available up to 95% of the as-improved value for 1 or 2 unit owner-occupied properties, and up to 90% for 3 or 4 unit properties. The lending value is determined by CMHC based on the lower of the market value or the purchase price and /or cost of construction. For those venturing into new construction, CMHC requires that financing be approved prior to the start of construction or at an early stage. The lender must maintain control of the entire building during the construction period, and CMHC-insured financing, along with any equity in the land, must be utilized to facilitate construction and completion of the project. However, condominium construction financing and loan advances on vacant land are not permitted. There are different acceptable construction arrangements under the program, such as owner-built homes where the borrower holds the title to the land by the first advance and either performs the work themselves or manages the construction. Alternatively, contract-built homes involve the borrower holding the title to the land by the first advance and having a contract with a single builder to construct the home. In home builder pre-sold arrangements, the builder retains title to the land during construction. CMHC offers 2 progress advance options for new construction loans: full service and basic service. In full service, CMHC validates advances for up to 4 consecutive advances at no cost, While in basic service, the lender validates advances without pre-approval from CMHC. A new home warranty must be in place for all new homes, with evidence of enrollment in a recognized new home warranty program required in all provinces and territories where such programs are available. For improvement loans, the property is assessed on a dual basis, the as-is value and the as-improved value, which is used to determine the loan-to-value ratio and down payment requirements. If proposed improvements are generally accepted to add value to a property, the lender can submit to CMHC the as-is value plus the cost of improvements. The lending value is the lesser of the as-improved value, or the as-is value plus the cost of improvements. Eligible borrowers for CMHC improvement must be Canadian citizens, permanent residents, or non-permanent residents authorized to work in Canada. The loan-to-value ratios for homeowner loans can go up to 95% for 1 to 2 units and up to 90% for 3 to 4 units. For small rental loans, the minimum equity requirement is 20%. The maximum purchase price or lending value for homeowner loans is $1.5 million, while for small rental loans, it is $1 million. Traditional down payments are accepted from sources like savings or the sale of a property. However, non-traditional down payments, which can include unsecured personal loans or lines of credit, are available for 1 or 2 unit properties with a loan-to-value ratio of 90.01% to 95%, provided the borrower has a strong credit management history. Rental income approaches vary depending on whether the property is owner-occupied or not. The CMHC Improvement Program also outlines creditworthiness requirements, where at least one borrower must have a minimum credit score of 600. CMHC may consider alternative methods of establishing creditworthiness for those without a credit history. Additionally, the gross debt service ratio and total debt service ratio must be calculated using an interest rate that is the greater of the contract interest rate, plus 2% or 5.25%. Non-permanent residents can also benefit from this program, provided they are legally authorized to work in Canada and meet certain conditions. The mortgage loan insurance is available for properties with 1 to 4 units, with at least 1 unit being owner-occupied. If a Canadian credit report is unavailable, alternative methods such as an international credit report or a letter of reference from the borrower's financial institution in their country of origin may be considered. Shifting gears, let's delve into a recent report from BMO that paints a rather cautious picture for the Canadian real estate market. According to BMO, the market is expected to remain sluggish, with no immediate relief from rising mortgage rates. Home prices continue to be high, pricing out many potential buyers, and the bank sees little chance of a market pickup in the near term under these conditions. The Bank of Canada, or BOC, is a key player in setting mortgage rates, particularly when it comes to variable rate mortgages. The BOC's decisions are influenced by inflation expectations, which in turn affects short-term borrowing costs. As inflation expectations rise, the BOC is constrained in its ability to lower the overnight rate, which is anticipated to remain steady at the upcoming July meeting. This stability is expected to keep variable rates in the mid-4% range through September or October, according to BMO. Fixed-rate mortgages, on the other hand, are impacted by Government of Canada bond yields. Recently, these yields have surged, reaching near 52-week highs, and have increased by more than 60 basis points from their spring lows. This rise in bond yields is likely to halt any downward trend in 5-year fixed rates, and may even push them up slightly, as noted by BMO senior economist Robert Kavchich. The factors driving the increase in bond yields include elevated inflation expectations and the increased borrowing needs of policymakers. These elements create upward pressure, raising the cost of borrowing. While BMO's report doesn't delve into all the specifics, the broader economic context suggests that higher bond yields are here to stay for the foreseeable future. BMO's outlook for the real estate market remains cautious. Despite a slowdown in demand, home prices have not seen significant reductions. Some signs of a second wave of price corrections are emerging, but they are still in the early stages. The market faces challenges with credit not being affordable enough and prices not increasing quickly enough to attract the speculative investors who fueled demand in recent years. End users continue to be priced out, even as policymakers try to expand leverage and extend repayment terms. As BMO's Robert Kavchich points out, the psychology of housing has shifted, bringing cash flow and affordability fundamentals back into focus. At current mortgage rate and home price levels, the market remains constrained, with deeper price cuts and improved affordability being the potential catalysts for revitalizing demand. While the landscape may seem challenging, there's always a silver lining. These market conditions could present opportunities for those looking to enter the multifamily sector, where strategic investments might yield long-term benefits. As always, staying informed and agile will be key to navigating this evolving market. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.